Good afternoon and welcome to today's webinar between Regal Securities and OptionsPlay. And today's topic is covered calls. My name is Scott Green, Marketing Director with Regal Securities. And pretty soon I'll be joined by Tony Zhang from OptionsPlay, who does all our OptionsPlay webinars. And he'll go over covered calls and take your questions at the very end. We'll be going over what are covered calls, steps to implement a covered call strategy, analyzing opportunities, automating your income strategy, and more. OptionsPlay, if you are new, is a highly integrated feature in your trading platform, and it helps you with the analysis, strategy, and research for trading options. So shortly after I introduce Tony, he'll be going over the income generating strategies, and then he'll have time for about 15 minutes of Q&A at the very end. There are chat boxes, both a chat box and a Q&A box. Please feel free to submit your questions at any time during the webinar, and we'll get to as many as we can at the end. Just want to quickly share this disclaimer. The types of securities forms and research tools used in this webinar are for demonstration purposes only and should not be considered a recommendation by Regal Securities or a solicitation or an offer to buy or sell any options. This webinar is being recorded and is not intended to be used for individual tax, legal, or investment planning advice. And since this webinar is being recorded, we will be sharing it. We'll be on the lookout for an email after our webinar the next day or two, probably later this week, when we'll be able to have the recording ready to be viewed on demand online. So be on the lookout for an email with a link to the recording. And now I just want to introduce Tony Zhang, the Chief Strategist at OptionsPlay, who will be presenting for us in just a moment. Tony is actually live in Las Vegas right now at the Traders Expo, where he will be a speaker during the conference. He participates in many speaking events, but Tony has 12 years financial services experience. He oversees the OptionsPlay development team that has led to the creation of some of the most innovative tools in the options trading and analysis. The tool OptionsPlay is their flagship product. It's embedded with several major sell-side brokerage firms, and there's a direct-to-consumer platform, and Tony has helped build up all the product there and bringing it to market. Now, with that being said, I want to hand it over to Tony. Tony, go ahead.
Thank you, Scott. Thank you, everyone, for joining me. Let me just go ahead and share my screen. So thank you, everyone, for taking the time out this afternoon. As Scott said, today we're going to be talking about cover calls. And why should we sell cover calls? Is because we want to generate income. So today what I really want to talk about is how to generate consistent income in your portfolio with weekly options. And we're going to focus this topic using cover calls because that's the most popular option trading, selling, and option selling strategy. For any of you that are ever approved for an options account, you'll know that the first level or first option strategy you're approved for is cover calls, and every other option selling strategy such as short puts, credit spreads, butterflies, iron condors are all kind of variations off of this first step that you take in learning how to sell options for income. So today we're going to focus our attention on what are the best practices for selling cover calls. We'll even start by talking a little bit about what is a cover call for those of you that are brand new. So this is a webinar really for beginners or even experienced traders. If you're a beginner, this is really designed to help you understand the strategy, understand what you should be looking for when you're selling cover calls. And for those of you that have already sold cover calls, what we really want to show you is a set of tools here provided to you free of charge at Regal Securities. Specifically OptionsPlay, that's going to make your life a lot simpler in helping you find the ideal cover call for your portfolio. So we'll discuss different preferences that people will have when it comes to selecting the appropriate cover call to suit your time frame and your risk tolerance, and then more importantly, show you how we can utilize our tool to quickly find you the cover calls that suits your criterias without having to do a lot of manual searching that sometimes can lead to error and can sometimes our emotions get into play. We want to try to help you avoid all of this through automation. That's what we're going to show you here today. So I'm going to start off by talking about what is a cover call for those of you that are brand new. More importantly, why should you use cover calls, especially for those of you that are newer to options selling strategies or options trading in general. This is the most popular strategy to generate some income. So we wanted to show you why you should consider utilizing this strategy. And then how can you actually generate consistent income? How can you get consistency from this type of strategy? And that really comes down to some of the things we'll discuss in terms of how frequently you should trade and what your risk tolerance when you're selecting covered calls to sell. That's going to help you gain consistency. And then what I want to do is spend most of our time actually showing you OptionsPlay and how you can quickly find a cover call opportunity within just a few seconds using OptionsPlay, as opposed to a few minutes that traditionally you may have to find going through pages and pages of option chains. And then lastly, what we'll do is I'll actually jump back to the slides a little bit, because we do get a lot of questions about exit strategies. How do you actually maintain a cover call position once you're in them? So we'll cover the three basic outcomes that you will likely face when you sell a cover call and how to account for each one of those different scenarios. So I'll start by talking about what is a cover call. So cover calls are really simple. If any of you have any stock account in your trading account, you can sell a cover call. A cover call is essentially taking your existing stock position, and it requires at least 100 shares minimum. So if you have some stocks that's not at least 100 shares, this is not a strategy that you can trade. But all you're doing is you're selling a call option against the stock that you own. And that combined, the call option you sell against the stock that you own is what we call a cover call. And for doing so, you're going to receive some income for selling this cover call. So what are some of the benefits for that? Why should you use cover calls? Number one, it generates consistent income because it's something that you can do over and over again on the stock that you own in your account in order to generate income. You can think of this almost like the dividend payments that you get from the stock that you own. And some stocks that you own may not even pay any dividends. So you may not be getting any income at all from some of the stocks in your portfolio. So this is one way to add some yield to your portfolio. This also, because you're generating income in your portfolio, that's going to lower the volatility of your overall portfolio, as well as the net cost basis of the stock that you own. So if you have a $100 stock and you can sell a call for $1, then your net cost for that stock is now going to be down to $99. And you can do that over and over again and consistently bring down the net cost basis of the stock that you own. And lastly, the best part is that it's used on the existing stocks in your portfolio. What that means is that you don't need to outlay any additional capital. You don't need to buy anything. You don't need to add additional risk to your portfolio. It's simply taking the existing stocks in your portfolio and allowing you to utilize those assets in your portfolio to generate some income. So that's really why you should consider taking a look at cover calls, especially if you're brand new to options trading. This is really a good place to start. Now, there are some limitations to the strategy because when you sell a cover call, it limits the upside return of the stock that you own to the strike price that you sell the cover call in. And that's really one of the key areas that we want to explore today, is understanding what is the appropriate strike price to sell a cover call on, so that you are still getting enough income to generate income, but at the same time, you're not limiting the upside return of your stock very much. That's really the key in selecting the appropriate strike prices. The second part is that it does require at least 100 shares. I know many of you, especially since there hasn't been a lot of stock splits recently, some stocks are really high priced, like Amazon at $1,600. It's difficult to acquire 100 shares. So this is not something that's applicable to all shares. It's only to the shares that you have at least 100 shares of. And lastly, you do risk selling the stock or losing the stock at the strike price that you sell. So it's really important to understand how to manage these trades, which is something we'll cover here as well. So how can you generate consistent income in your portfolio? And the first thing to remember is that this strategy is not a one-size-fits-all strategy. What that means is that every single one of us is slightly different in how we trade, how frequently we trade, what our risk tolerance is. And it's really important to make sure you understand how to go about selecting the appropriate risk tolerance and both expiration date and strike prices. So We'll talk a little bit about the details of how to select expirations and strike prices in the next few slides, but to generate consistent income is actually quite simple. You just simply have to choose an expiration date and strike price based on your personalized preferences, and we'll discuss what some of those personalized preferences are in the next few slides. But all you have to really do is make sure that you're selecting expiration dates and strike prices based on your personal preferences, and in order to generate consistency, you just have to use the same methodical approach cycle after cycle. So if you sell monthly cover calls, every single month, you should choose the same type of expiration date and strike prices every single time to gain consistency. Now, that might sound really simple and fairly easy, and in reality, it actually is. However, we tend to find that when you're going about selecting your expiration dates and strike prices, certain factors come into play. A lot of times, emotions come into play. A lot of times, we're looking for a certain amount of income, and if we don't find it, we tend to adjust our strategy a little until we get the income level that we're expecting or the income level that we want. And that's where we tend to deviate away from our strategy. And that's why we always want to bring in automation, because automation helps facilitate this consistency. If automation is helping you find your expiration date and strike price, you're less likely to change your expiration dates and strike prices based on emotional needs. So this is really one of the things, the key areas of what we're trying to bring to your trading is not only intelligence, but also automation that helps you stick to the plan that you set out for yourself. And that's really what we're hoping to show you here today. So we talked about when you're selling cover calls, you need to select two things. You need to select an expiration date and a strike price. So how do you go about selecting your expiration date? And this really comes down to simply how actively you trade. That will help you determine what is the appropriate expiration date. So for example, myself, I'm fall into the active trader category because I have the time to look at my account pretty much on a daily basis. I would typically sell shorter dated option strategies anywhere from 21 to 49 days out. So this is anywhere from 3 to 7 weeks out. And that's really the bulk of where weekly options are traded. So for those of you that sell weekly options or are familiar with weekly options, this is really the time that you spend most of your time on when you're a fairly active trader is those front month and weekly options. If you're a long-term buy and hold investor, which is basically the exact opposite end of the spectrum, if you're a buy and hold investor and you simply buy and hold on to stocks for maybe months or maybe even years, perhaps you only look at your account once a month or once a quarter, you would fall into the long end of the spectrum in terms of expiration dates. You generally want to choose anywhere from 3 to 6 months out when you're selling your cover calls. And then most of you will probably fall somewhere in between that. So this is what I call casual investors. For those of you that look at your account maybe once a week, you're not very active, you're certainly not trading every day. You want to choose expiration dates that are somewhere in that middle, between 50 to 89 days out. So about 7 weeks to about 3 months out is the time frame that you typically choose. So before we move on, kind of make a mental note to yourself. Which one of these 3 categories do you fall under? Are you an active trader, buy and hold investor, or somewhere in the middle? Because that's going to help you determine which expiration date you're going to choose. And looking at the different expiration dates, what I want to point out is how that affects the income that you receive. So when you sell a short-dated option, when I sell an option that's expiring 3 weeks or 4 weeks, I generally have a lot more certainty as to what's going to happen between now and expiration. So things like earnings announcements, dividend payments, even things like news announcements and product launches and things like that that may have a material impact on the stock price. These are things that we generally have a fair amount of visibility in the next 3 to 4 weeks. Versus if you're selling a 6-month option, you tend to have a lot less certainty. So what you get is this trade-off between certainty and income, because the more certainty you have, the less income you're going to receive. So when you sell short-dated options, you're actually going to receive less income than if you sell a long-dated option. Okay, so I hope that makes sense. So the question is, which one based on our backtest do you see historically have the highest return? And a lot of people, what they tend to do is they tend to move towards longer dated options because they want more income. But what our research shows, basically you should be doing roughly kind of the opposite of that. We generally find that more certainty is certainly better for you in the long run for selling cover calls. And the reason for this is really because when we're selling short-dated options, we have the opportunity to avoid selling calls during earnings. So for example, if we're selling 1 month calls, we can do that 12 times a year. So if we do that 12 times a year and there's 4 earning cycles every single year, then only a quarter of the calls that we sell have this large uncertainty factor built into it during earnings. So we've generally found that selling cover calls or selling any options during earnings is usually not a good strategy. So we really want to try to avoid that. But sometimes when you're selling long dated options, so if you're selling a 3-month option, you really don't have the opportunity or the choice to avoid it, because every single call that you sell, 100% of the calls that you sell will have this large uncertainty factor or earnings built into it. So you really can't avoid it. So that's one of the reasons why we suggest to sell shorter dated options, because you can sell options and simply skip the months that have earnings coming up. And the second thing that we found is that premium is not linear to time. So we talked about the longer you go out in time, the more income you get, but you're not actually getting paid the same amount. What I mean by that is if you're looking at a 1 month call and you have X amount of premium, so let's say you're collecting $1 on a 1 month call, chances are when you're selling a 3-month call, you're not going to collect $3. A lot of times what we're seeing is that average is roughly only about 2 times the premium of a 1 month call. So even though you're taking 3 times the amount of risk or 3 times the amount of time, you're not getting paid necessarily for that. So you're not getting 3 times the incomes. That's why we generally recommend to sell 1 month calls, because you could do those two months in a row and still collect the same $2 as someone selling a 3-month call. And you can even avoid that 1 month during earnings and still come out with the same amount of income as someone who sold a 3-month call without the risk of potentially having that earnings announcement go against you when you're selling cover calls. So that's really one of the reasons why we find it's better to be on the shorter end of the spectrum when you're selling cover calls. Next, I want to talk about strike selection. So when you're selling a cover call, you have to figure out what strike price you want to sell, because that's going to be the strike price that you could potentially sell your stock at. So it's really important that you select the right strike price. So for selecting your strike selection, it's really comes down to your risk tolerance. You have to look at how much risk can I take, or how much risk am I willing to take, and that's going to help you dictate what strike prices are suitable for that. So on the conservative end of the spectrum, this is for those of you that have low cost basis stock. Maybe you don't want to, maybe you've held on to it for a long time. It's stock that you certainly don't want to sell or don't have intentions of selling. Or maybe it's stock that you have some dividends on and you rely on those dividends for income. So you want to make sure you keep these stocks. You would fall under the conservative end of the spectrum, meaning you want to make sure that the risk of you losing that stock is very low. And for those types of strikes, you want to choose roughly about a 10 delta strike price. We always use delta to choose our strike prices because delta already accounts for changes in volatility. If we choose 5% out of the money, that doesn't account for the fact that some months are more volatile than others, such as earnings. And it doesn't account for that change in volatility. So 5% when there's no earnings coming up may be sufficient, but 5% is probably not enough when earnings is coming up. So delta adjusts for that change in volatility and will automatically select a strike that's further away when volatility is high, and automatically select a strike that's closer to the current price when volatility is low. And for those of you that are not familiar with delta, delta gives us an approximation of that strike price being in the money at expiration or out of the money. So 90% chance of a call being will expire worthless is what a 10 delta translates to. On the other end of the spectrum, for those of you that are looking to chase yield, meaning you don't care if your stock gets called away, you just want to make as much profit as possible, you would fall under the aggressive end of the spectrum. You want to choose strike prices that have roughly about a 30 delta or only a 70% chance of that call expiring worthless, and you keeping your income. And most of you will probably fall somewhere in between. I myself, certainly, I'm categorized more on the optimal side. This is where you want to choose roughly a 20 delta call, about an 80% chance that you'll keep the income on the cover call that you sell. So before we move on, make a mental note to yourself, which one of these three do you fall under in terms of risk tolerance? Because that's going to help you determine which cover calls are suitable for your risk tolerance. So when we're looking at strike prices, when we're talking about a conservative strike price, a 10 delta strike price, that's a call that's relatively far away from the current price. And what that does is these higher strikes give your stock a lot more upside. So a lot more room for your stock to grow before the stock gets called away or sold off. And this results in less income because you have a very low probability of that event happening. Conversely, for those of you that are on the aggressive end of the spectrum, you're selecting much lower strike prices that are much closer to the current price, which means that your stock has a lot less upside to grow before it gets called away or you sell your stock at the strike price that you've sold it at, and that results in more income. So the question is, which one, based on his history, do we see has the highest returns for trading? And the answer actually is, surprisingly, the conservative end of the spectrum. You would think that aggressive gives you more income, but the reason we find that the conservative end of the spectrum gives you higher performance for this strategy is because this is what's considered a negative risk to reward strategy. When you're selling a call, your upside is the reward is limited to the premium that you've sold, but the lost opportunity is unlimited. What I mean by that is, if let's say you have $100 stock and you sell a 110 call against it, and you in your mind you're thinking, oh, $10 move, it's pretty good. If I make a $10 return on the stock and I collect $1, I make $11 profit. I'm happy. But let's say that stock overnight, because of some news comes out, shoots up to $200. Now you've sold your stock at 110. On a stock that's trading at $200. So you lost out on $90 of potential opportunity. It's not a real loss to you because you've still made your $11 profit, but you haven't made as much as you could have if you didn't sell those cover calls. Now, that is an extreme example that I'm giving you, and certainly happens very, very rarely, and it's not something that you necessarily should account for when you're selling cover calls, but that lost opportunity is real. And sometimes that stock may not go to 200, but it might go to 115 or 120, and you've lost out on $5 or $10 in profit. So that's why when we find that when you're selling these types of strategies, a lot of the losses come from lost opportunity, not from actual losses. So we find that it's much more important for your stock to have some upside, much more important for you to have upside than to try to collect large premiums, because large premiums is going to result in having a lot of lost opportunity. And that lost opportunity, like I said, is unlimited, because the stock shoots up to 1,000, you can lose out on $900 worth of profit. You want to make sure that you have some understanding as to, you want to make sure that you allow your stocks to appreciate in value, because that's why you own those stocks. You own those stocks because you think they're going to go higher in value. So make sure you give yourself some room when you're selling covered calls. So now that we talked about finding expiration dates, strike prices, how do we know that once we're looking at that expiration and strike price, if we're getting enough income for that strategy? Because you might follow exactly what I'm telling you to do, and then on some calls you might find that they're trading at 10 cents, other ones are trading at 50 cents, other ones are trading at $5. How do you know you're getting enough income? And this is actually fairly easy to figure out. Number one, you want to compare the cover call yield to the dividend yield, because you can think of selling cover calls as really almost like capturing a dividend. And you usually don't look at dividends in terms of dollar amount, we look at it in terms of yield. And we should want to look at cover calls the same way. And how we want to compare it is we want to at least beat the dividend yield with the cover call yield. Now, for those of you that are saying, how do I know what the cover call yield is? Don't worry, OptionsPlay calculates it all for you. So all you have to do is just compare the dividend yield to the cover call yield, and that will help you determine whether you're getting enough income. So I have three examples here. I have a 3% cover, a call that has a 3% yield on a stock that currently pays you a 1% dividend. This is the type of strategies that you want to look for, because you're only collecting 1% dividend on the stock, not a lot of money. So now you can add a cover call to it, which brings your total yield to 4%. So you move from 1% to 4%. These are the type of opportunities that cover calls you want to be looking for. In the middle, I have somewhat of a neutral or kind of minimum, if you will, where a stock is giving you a 3% cover call on a stock that already pays a 3% dividend yield. So a stock with a relatively high dividend yield, you're already capturing 3%. You want to make sure you're making an additional at least 3% for it to be worth the risk of potentially selling your stock. And lastly, if you're looking at an opportunity where the yield on a covered call is only 1%, while the stock is paying you a 3% dividend, so you're only increasing your yield from 3% to 4%, this might be the opportunity that you should potentially pass on, because you're simply not getting enough yield for this covered call to take on the risk of potentially losing your stock at that strike price. So that's how you go about selecting your expiration date, your strike price, and figuring out if there's enough income in the strategy that you're trading. So to sum all this up, we've back tested these covered call results. We've looked at expiration dates, and we really find that it's better to prioritize certainty over premium, meaning selling shorter dated options, getting understanding as to where, how much, what's going to happen between now and expiration, and doing that many times over and over again is better for you than selling long dated calls. And then when it comes to selecting strike prices, we find the most important aspect when you're selecting your strike prices is making sure that you have enough room for your stock to grow so that you don't have a lot of lost opportunity on that stock, which is going to create a drag on your portfolio. So those are the two things that you want to look out for when you're selecting expiration dates and strike prices. So based on our back test, we generally find that, shorter dated options, 21 to 49 days out, tend to have better performance. And when it comes to strike prices, somewhere in between that optimal and conservative strikes generally gives you the highest return. So anywhere between a 10 to 15 delta is usually that sweet spot that we find that gives you the right balance between having enough upside for your stock, but at the same time still producing enough income to be made worth your while. And what we see is these types of strategies will perform roughly about a 3.5% return on your portfolio in addition to the stock returns that you have from your portfolio. So those are some of the results that we have back tested using this type of strategy. Using these types of parameters. So now what I want to do is I want to jump over to OptionsPlay, and I want to actually show you guys the tool that you guys have access to here at Regal Securities, and more importantly, show you how easy it is to take what you've just learned here during our webinar and actually start applying it to your portfolio. For those of you that are brand new to options trading and maybe you've never done one before, you might find that taking a look at option chains, which is traditionally where you would start on an option trade, it can be a little overwhelming, it can be a little confusing, and let alone, even if you did all that work that I told you, it's quite a bit of manual work to go out there and find the right expiration. So, I said that I want to look for roughly 3 weeks out. So maybe I want to look at the December 24th expiration. It allows me to quickly look at some expirations. I would look at deltas to select my strike price. So as you can see, there's quite a bit of manual work that goes into selecting my expiration, my strike price. And then once I figure that out, I still have to crunch some numbers to say how much yield is there here. So not all the information that you need is available through the option chain. So what we wanted to do is create a brand new user experience that didn't require you to go through pages and pages of option chains just to find a starting point. We wanted to provide you that starting point instantly. So for those of you that have never seen this before, OptionsPlay is a tool that's available to you. You can click on the OptionsPlay tab in the upper right-hand corner to launch OptionsPlay. The platform is divided into 3 sections. We have trade ideas and watch lists on the left, our security analysis panel here in the middle, and trading and income here on the right-hand side. So for today's webinar, we're going to focus our attention on the income tab. This is really designed to, again, help you start figuring out which cover call and cash secured put, for those of you that are looking for more advanced strategies like short puts, how to quickly find your ideal starting point. So today we're going to focus our attention on cover calls, but for those of you that like to sell puts, you can utilize this tool for that as well. And when you click on the income tab, there's a button here at the bottom that says income settings. This allows you to set those settings that we just talked about. So for myself, like I said, because I'm fairly active, I would choose short dated options, so 21 to 49 days out. For risk tolerance, I'm not too conservative, I'm not too aggressive, so I'm somewhere in the middle. So I choose optimal when it comes to risk tolerance. And you can set these independently of each other for calls and puts. So for those of you that have experience trading puts or want to look at trading puts, you can set different preferences for your puts. So for example, for myself, I still choose short term for puts, but I like to get a little bit more aggressive because I want to own these stocks that I sell. So when I sell a put, I want to know that I have a higher probability of being assigned. So I set these settings independently of each other for calls and puts. And once I've created all my settings, all you have to do is click on Save as Default. And what I've created here on the left is I have a watch list. I just have a list of stocks. These aren't particular stocks of any particular note. It's just that these are relatively large, big cap names that many of you may have in your portfolio. And what I want to do is just show you how easy it is to click on a symbol such as Facebook, which many of you may own this stock. Many of you may be taking a loss on this stock if you own this stock. And see how easy it is to sell a cover call. So as you can see, once I clicked on Facebook, it loaded up the optimal cover call for me based on my settings. So here it'll ask me, do I own shares of Facebook? I can select yes. I can enter the number of shares if I wanted to. And what it does is it tells me exactly which cover calls to start looking at. So it's telling me to look at the December 7th, 152.5 cover calls. So Facebook's at 142. So this is basically $10 above the current price, and this expires in 24 days. So what you're doing is you're effectively saying in the next 24 days, I don't think this stock's going to rally above 152.5. If it does, then I've basically effectively sold my stock at $152.5 plus the premium that I'm receiving here, which is $220. So I'm going to collect $220 in income. As you can see, selling the December 7th 152.5 cover calls generate $220 in income. They produce an 11% annualized return on a stock that pays you 0 dividends. If you own Facebook stock, you are currently getting 0 in terms of yield. How would you like to add approximately 11% on top of that? I think that would be certainly attractive for a lot of people, is being able to generate an 11% yield on the stock that currently yields them nothing. Which will help offset the cost of the stock that you own, which will offset some of the volatility in the stock by selling cover calls. And what this does is it gives you all the underlying information you need, because it tells you both an expiration date, strike price, as well as the annualized yield of the cover call, so that you can quickly understand what is the right expiration date, what is the right strike price, and am I getting enough income for this trade? And once you're ready to place that trade, you can hit the trade button. What we have is a preview order button that allows you to fill out a ticket for you. This is one of the best parts of the integration that we've done with Regal Securities, is that we will pre-fill the ticket for you so that you don't have to worry if you're doing anything wrong. Everything's pre-filled for you, so you can just hit verify and send this off for execution. And this is all designed to make your life from finding an options trade as simple as possible by introducing automation, because you don't have to manually search through pages like this to get to the right expiration date and strike price. It already brings you to all of those starting points, and then more importantly, gives you analytics so to decide, is this enough income? And I think the best way to illustrate how easy this is for me to go through a lot of different stocks and show you just how easy it is to find a cover call opportunity on any of these stocks that I'm showing you here. So let's look at Goldman Sachs. Stock's taken a huge beating over the last couple of days. I think it's important to take a look at where this stock, if you own the stock, you've probably taken a big loss. You might be looking for some ways to cushion some of that. So Goldman Sachs is trading at 205 right now. This is telling me to look at the December 7th, 217.5 cover call. So about $12.5 above the current price, giving you 24 days for the stock to not rally $12.5. And if it doesn't, you keep $168 in income, which is a roughly annualized return of 12% on a stock that pays currently a 1.5% dividend yield. So you're adding an additional 12.5% to it, which brings your total yield on the stock to 14%. So if you're currently owning Goldman Sachs, you only get 1.5% yield. This is yielding you an additional 12.5%. This is the type of opportunities that you want to look for when you're trying to generate income for your portfolio. Let's move on. Let's look at Intel. Intel's trading at 47.39, one of the semiconductors. Not a very hot stock right now, unlike earlier in the year. Intel's trading at 47.39. This is telling me to look at the December 7th, 50.5 cover call. So roughly about $3 above the current price. Look at this yield, another 11% yield on a stock that pays a 2.5% dividend. That brings your total yield again to roughly 14%. And like I said, because I'm optimal, this has about a 70% that this call will, 80% chance that this call will expire worthless. Those are the types of statistics that I'm looking for, something with a high probability of profit and giving me the yield that's going to greatly increase the yield on the stocks I own in my account. And at the same time, giving this stock still quite a bit of room to grow, up to $50.5 in 24 days, so in less than a month. almost a 7 to 8% return. Certainly nothing to sneeze at. Lockheed Martin, 305, trading at 305. This is telling me to look at the December 7th, 320 calls. So $15 above the current price, yield of 9.2% on a stock that pays a 2.88% dividend, allowing me to take in $185 in premium for every 100 shares. So let's say you own 500 shares of Lockheed Martin. Here, as you can see, this will automatically adjust for you. So now with 500 shares, you can generate $925 in income. So this is really designed to allow you to quickly find the ideal starting point for your expiration date and strike price, plug in your the number of shares that you own, and see instantly how much income you can actually receive. And as you can see, I've already gone through 4 or 5 stocks here. I didn't have to do any manual searching. I didn't have to do any spend any time going through option chains. This makes it just very easy for me to go through a list of stocks and immediately see where are the opportunities to generate some income. AT&T at $30. This is telling me to sell the December 14th 32 cover calls. So this one's 31 days away, but it's generating me $20 in income. But this is a relatively low stock, so the yield here is still 7.76. So AT&T already pays a really hefty 6.5% dividend. That's probably 3 or 4 times the average of an S&P 500 stock. So you're getting a lot higher dividends on AT&T, especially after the stock has taken a bit of a tumble. But you can still add an additional 7% yield on top of that really big yield, so bringing your total yield again to roughly 14%. These are the types of opportunities you want to look for. And this is why cover calls is the most popular strategy amongst options traders, because you can generate yield without adding additional risk to your portfolio. Every other strategy, selling puts, selling credit spreads, selling butterflies, iron condors, these are all strategies that will add additional risk to your portfolio. Cover calls is the only one that doesn't. Let's look at 3M. Trading at 198. This is telling me to look at the December 7th to 10 calls. So roughly about $11 above, $12 above the current price, bringing me $83 in income or 6% yield on a stock that pays a 2.76% dividend yield. So almost triple, or a little more than double the, a little bit more than double the yield on the stock that you get from the dividend. And as you can see, as I do more and more examples of this, you'll see how easy it is to go through a big list of stocks. Whoops, I don't know what happened there here. It's really easy for you to click through a long list of stocks and instantly be able to see where is the cover call opportunity. Apple at 192, taking a huge tumble the last few days. Looking at selling December 7th, 205 cover calls, which generates 12% yield on a stock that pays only a 1.5% dividend. This is exactly the type of opportunities to help you generate additional yield on the stocks that you already have in your account. Because if you're not selling cover calls, Apple stock is just going to sit in your account. You're not going to generate additional yield. This is one of the ways that you should utilize the assets that are sitting in your account. If you're not doing them, you're not utilizing them fully to maximize the income you can get from the assets that you already own. And this is really one of the key ways to unleashing kind of the power of the assets that you currently own in your account. Cigna 213, telling me to look at the December 7th 225 cover call. So about $12.50 or $12 above the current price, generating me $100 in income, 7.2% yield on a stock that pays virtually 0 dividends, bringing my total yield to 7% from 0%. That's exactly why you should consider taking a look at these strategies. Now, as you can see, I can go down a list of 20, 30, 40 stocks and quickly see exactly which ones have opportunities and which ones don't. I don't know if I have an example one here, but maybe let me see if I can find you one. So sometimes in the really low price stocks, it's really difficult to find cover calls. So as you can see on this, you get a slightly different picture. Here you get a little blue bar with a red warning sign. This is telling me that OptionsPlay could not find me a short-term optimal cover call. And it's displaying to me the long-term aggressive, which is the next best alternative. This is designed to save you time from having to scroll through pages and pages of chains like this and then not finding what you're looking for. This tells you immediately if we're not able to find you something so that you can move on to the next one. As you can see, on a lot of the ones that we are able to find you anything, you're going to get the green bar with the check mark. That's telling you that, hey, we were able to find you a cover call that suits your criteria. Those are the ones that you want to pay attention to. And then whenever you come across one that looks like this, where you get the blue with the red warning sign, that just means that it might be time to just move on to the next stock so that you don't waste time trying to find a cover call on something that just doesn't exist. And that happens a lot, especially when you're dealing with smaller cap names or stocks that have lower volatility, or even stocks that have very low prices. It's going to be more difficult to find cover calls on those. So this is designed to not only save you time in finding a cover call, but save you time if there isn't a cover call available on that stock. So this allows you to, I recommend for those of you that are interested in selling this type of strategy, make sure you create a watch list with all your holdings, because that allows you to simply just click on a stock and see whether there's an opportunity to sell cover calls. If there's not, you can instantly move on to the next one. And as you can see, you don't waste any time. Within seconds, you see what the starting point is for both cover calls and cash secured puts. So for those of you that like to sell cash secured puts, you can click on the no button, and here it'll give you opportunities to sell puts. So here it's telling me to sell the December 7th, 317.5 puts, about $20 below the current price. As you can see, this is going to collect me $1,000 for every 100 shares that I want to sell. That's an annualized yield of 47%. Not something that you see very often as these high returns, because I can make $1,000 over the next 24 days, which is roughly 3% of the underlying price. So imagine if you can pick up Tesla at a 3% discount and pick it up at 317.5. Would you like to buy Tesla at 338, or would you like to buy Tesla at a lower price, or at least $1,000 lower than what you would buy currently? I think I would certainly like to buy Tesla at $1,000 cheaper if I could, or 3% cheaper as I could. And that's really why short puts is a good opportunity for you guys to look at if you're interested in buying some stocks as opposed to stocks that you already own. So with that, as you can see, please make sure that you set up a watch list for the holdings that you have. Make sure you go to the income tab and click on your income settings and create your cover call and cash secured put settings. And once you do that, you can just save that as default, and any symbol you type in, we will present you the cover call and cash secured put based on your personalized preferences to help you save you time, and really more importantly, make sure that we bring some automation into your strategies. So lastly with that, what I want to do is I just want to jump over back to the slides. When you're selling a cover call, there's really 3 scenarios that you'll come across. And I just want to take a look at kind of how you should handle each one. So first strategy, I think this is where people tend to panic a little, is when they sell a cover call and the stock shoots up maybe above the strike price, and there's still a few weeks left to go. This is where I see a lot of people panic because they see a large unrealized loss on the short put. The short call, and they're not sure what to do. And the answer here is to not panic. Don't do anything irrational. You want to hold on to a cover call. Even if it's above the strike price, you really don't have any risk of losing the stock until you're very close to expiration. So that's really why you want to hold on to that cover call. That will give the stock also an opportunity to potentially go back down below your strike price. And during that time it takes between the stock shooting up and expiration, you're going to capture time decay. You're going to capture that option decaying in value, and that's what you're here to do. So you want to make sure you capture that first before you roll your position. And rolling position simply just means closing out your existing cover call and selling a new one. So you only want to roll in that last week. After you've collected all the time decay, after you've collected all the time premium, then you want to roll. Especially if it's at a loss, you want to roll that trade only in the last week. The only rule of thumb here as far as to when you might want to roll is if the stock really shoots up significantly, and this is what I mean when the stock shoots up 20, 30% above your strike price, and that call option that you've sold is now a 90 delta call, so a very deep in the money call. That is also an option for when it's time to pull the plug on a cover call. Next scenario, when the stock goes sideways, you sell a cover call and the stock just trades sideways. This is your best case scenario. This is when you want to hold on to the position until expiration. You want to let this call basically expire worthless, and you get to do it over again the next expiration cycle. Lastly, if you sell a cover call and the stock plummets, like maybe in the example of like Goldman Sachs or Apple, this is really the only time when it makes sense to roll your position early. Meaning even if you haven't captured even though there's still plenty of time left to go, if you are able to buy back the call that you sold at 20% of the original premium that you sold it for. So if you sold the cover call for $1,000, you can buy it back now for $200 or less. This is when you want to roll your cover call early. And this is when you're basically taking profits early and trying to sell another cover call, even though you still have a few weeks left on the cover call that you've just bought back. And this is really what we call hitting doubles, when you're able to capture double the amount of premium in the time frame because the stock plummets. That's how you go about handling each one of those three scenarios. So with that, what I want to do is I just want to bring this back to OptionsPlay. I want to thank everyone for taking the time out this afternoon to listen to us on this webinar. For those of you that are brand new to options trading, this is really where you want to start out. This is where you learn how to sell options. This is where you learn the benefit of selling options is by selling cover calls, and that's going to help you expand into other strategies like short puts, credit spreads, that you're going to be able to increase your trading capacity by learning more of these strategies by first understanding cover calls. So with that, I'm going to open this up for Q&A. I have time for about 10 minutes worth of questions and answers, so please type them into the chat window or the Q&A window, and I'll answer as many questions as I have time for. If you're not in a long stock position, what criteria would you use to find a good stock for call writing? Would you recommend a buy right strategy to buy that stock? Really good question. I generally don't believe in the buy right strategy, and the reason for that is because you're basically taking on a huge amount of risk to try to capture, sometimes what could be $30, $40, $50 in income. It's not worth the stock price. For example, I wouldn't go out and buy Verizon at $5,800 because that's what it would cost me to buy 100 shares of Verizon. It doesn't make sense for me to risk $5,800 to try to make $29. So that's why I'm not a big fan of the buy right strategy. This is really a strategy for stocks that you already own in your portfolio. What should we look for with regard to open interest when selling? That's a great question. We generally don't look at open interest at all because open interest is not many times a good indication of liquidity, but that's why we have on our strategy checklist, when you hit the trade button, a scan for spread and liquidity. We use the bid and ask spread between the buy and the sell price in order to determine liquidity. So even though Verizon on this December 7th 61 calls may have very little open interest, but when we look at the spread, 29 cents for 32 cents, that's a pretty tight spread. That's how we know this call is liquid. So open interest just means if anyone else has traded that. There are thousands of strikes. Sometimes just no one's traded the strike that you want to trade, but that has nothing to do with liquidity. So keep that in mind when you're looking at open interest. It's not a good indicator of liquidity. We do have this liquidity indicator here when you hit the trade button. That's a better way to gauge liquidity. If things start moving the wrong way, can you reverse out or buy back and get out of this play? Absolutely. So when you sell a cover call for 29 cents, maybe the stock shoots up and this call is now trading at $1. You can now buy back that call at $1. So you basically take that 80 cent or 71 cent loss on that trade. So yes, you can buy back that call back and reverse out of it, which means that you don't lose that stock, even if the stock goes above the strike price. Does the annualized or raw return allow for not trading during earnings? I'm not sure what that means. The annualized return is simply calculating how much this income is in terms of yield. It has nothing to do with earnings. But when you hit the trade button, there's a thing called the strategy checklist. During this, we actually check to see if there's earnings. So this is one of the things that we've already built into our strategy checklist, is checking to see if there's earnings between now and expiration. Can you download the watch list from comma delimited file? No, you cannot at this point. You can only maintain the watch list within OptionsPlay. Is the screener using bid, ask, or midpoint? Great question. So you can click on modify and you can use the natural price, which is the bid ask price, or you can use the mid price. So you can analyze the yield both based on the mid price, which is the best possible execution, or the bid ask price, which is the worst possible execution. So you have the choice of both. Is the short time frames adjustable, as in can I change the date range? So no, you cannot change that, but if you want to modify it, you always can. So this is designed to give you a starting point. You can always change that if you want. You can always modify it to change it to one extra expiration if you want, or one lower expiration just by the click of a mouse. And what we also have is the ability for you to look at an options grid. So maybe instead of looking at the whole chain, sometimes you just might want to make some minor adjustments. So maybe for our Verizon, you want to be more conservative. So you can choose maybe the December 21st 62.5 calls, or maybe you're a bit more aggressive, so you want to go for the 60 calls. So we allow you to make adjustments, but without showing the whole universe or showing you a limited universe. It's usually a little easier to select from. Can this analysis be used for longer-term bought calls as a long leg? Absolutely. If you want to replace the stock leg with long-term calls or a leap option, you absolutely can. We call those strategies a poor man's cover call, because if you don't have enough money to buy 100 shares, you may have enough money to buy a deep in the money leap. Usually those cost anywhere from 20, 30, 40% of the underlying, as opposed to 100%. So that certainly is one way to replace the long stock with a long leap. Can you give an example of a good selling point and a good buyback point? So this, like I said, this is a strategy you should be doing all the time. There's no entry and exit points. You should be selling cover calls pretty much consistently in your portfolio whenever you have a chance to, because if you're not, you're leaving yield on the table. And in terms of when you should get out, that's what I already covered in that spreadsheet for exiting trades. Is there somewhere we can review previous videos? Yes. Scott, if you don't mind, if you could just type into the link for the previously recorded webinars into the chat window so everyone can have a link to the previously recorded webinars, that would be great. So we'll send that link to everyone in the chat window, and it'll also be included in the email that we send out with the recording as well. Where do I find a manual for OptionsPlay? So we don't necessarily have a manual. However, all of our recorded webinars act as a manual, not only teaching you a specific strategy, but also the best practices. But most importantly, we actually show you how to use our tool with those strategies that we teach, very much like what we're doing here today. So today we're teaching cover calls, and we're teaching you how to sell cover calls on the stocks that you own in your account. And more importantly, we show you how to utilize our platform to find those cover calls. That's really how we train people in how to utilize our platform. Gerald's asking, do you ever sell leaps? We would never sell leaps. And this is really because you're not going to get enough premium in leaps. So for example, here, if I sold a 1 month call, I get roughly 40 cents for something with a 77% chance of expiring worthless. If I sell a leap, let's look at an expiration or a strike price that has roughly about a 70, what did I say, 77? So as you can see, if I go all the way out to June 2019, which is almost, what is this, almost 8 times as far? Yeah, almost 8 times as much, I'm only getting $107. So 8 times as much, I'm only getting paid about 2.5 times. Certainly, this is why we would never sell leaps. You're just not getting paid for it. You're going to take on a huge amount of risk of selling your stock at $65 over the next 8 months, but only collecting $107 versus selling a 30-day option with similar metrics in terms of similar probability of expiring worthless. You're going to collect $40. So just selling 2 monthly options is going to get you the same amount of an 8-month leap. That's why we never sell leaps as a cover call. Does it matter if the stock price that you own is above the current price? It does not. However, you do run the risk that you may end up selling that stock at a loss. So that's a risk that you have to decide whether you want to take. But like I said, you don't have to sell that stock at the strike price. If you really don't want to sell the stock, you can always buy back the call. So in my opinion, it doesn't matter. Any other questions? I only have 2 minutes left here today. I want to answer as many questions as possible, but I do have to run to the Traders Expo to give my speech. So any last questions before I sign off for today? If there are no other questions, I just want to thank everyone for taking the time out this afternoon. You know, we took a few weeks off from the webinars, but we'll be back here next week, I believe next Tuesday, again for another webinar. So we just sent the link in the chat window for the link to the previously recorded webinars for those of you that asked for a manual and just, you know, how to view all of our previously recorded webinars. Please check that link in the chat window. That's how you're going to be able to get that. So thank you so much, everyone, for taking the time out this afternoon. I really appreciate you guys taking the time out, and I will see you guys next week.
Thank you, Tony, once again for sharing all your expertise and just how powerful this OptionsPlay tool is, and for taking the time to answer everyone's questions. And thank you to all those who are attending and participating by asking questions. The more questions, the better. We really appreciate your interest and you attending our webinar. Again, you can find OptionsPlay in your live trading platform. It's here across the top in the tab. If you have any other questions, please reach out to the customer service team of your broker. And our next webinar will be 1 week from today, the Tuesday before Thanksgiving, around the same time, 3:15. Be on the lookout for the email topic and the registration link for that, and also be on the lookout for a link to our recording of today's webinar. We'll be sending that out in an email. Okay, so thanks again, everyone, for attending. And if you have any questions, please reach out to us. And everyone, have a great rest of the day. Bye-bye.